Welcome to Before and After. This show is all about opportunities around upcoming events and announcements and helping you understand not only what could happen, but what you can take away from what did happen. And the upcoming US non-manufacturing ISM is going to tell us a lot. Let's take a look at some of the possible scenarios in the before portion of our episode. The Institute of Supply Management, or ISM, non-manufacturing is absolutely key to upcoming market action, as it's this part of the US economy that isn't supposed to be a drag. Well, not yet, anyway. Unlike manufacturing, which has been taking a beating of late, the ISM non-manufacturing represents what's supposed to be the healthy parts of the economy, like business activity and employment. The manufacturing sector grabs most of the headlines, but the non-manufacturing or services sector is a much larger component of the US economy. The September number, released on October the 3rd, was a big shock, and the market did not like it. The instant it came out, the S&P plunged 1.2% in less than 15 minutes, an accelerated sell-off especially for this subdued volatility environment. Take a look at this Refinitiv chart. The September non-manufacturing ISM report missed badly. The expectation of 55.2 instead came in at 52.6. And remember, the magic number is 50. Below that, and we're in contraction territory. The manufacturing sector can contract without creating a recession. But on both the last two occasions that the non-manufacturing sector was heading to 50 and perhaps even below, the economy was heading towards recession. This is a key barometer to gauge whether the US economy is deteriorating and whether the slowdown is spreading to the services sector and then, ultimately, the consumer. So what should we be looking out for? A solid beat could create an upside panic in equities, followed by a key day reversal in stocks, a bit like a last hurrah before people lock in profits. Inline probably means tepid buying on unimportant volume. A miss, and you could very well see the same instant reaction as October's number, with stocks dropping into an air pocket and worrying about what happens until the next rate-setting meeting. Sub 50, and people will be reaching for the hard hats as the calls of recession will certainly start ratcheting up again. If you're looking for a way to play this though, consider the juicy way, the retail ETF. It had a 3% intraday range move at the last non-manufacturing ISM. This week we are going to look at BMW as they will announce earnings and we want to examine some possible actions. Take a look at this Refinitiv chart. BMW's earnings announcements come at a time when they face all sorts of macro issues. Autos have been at the epicenter of the slowdown in global manufacturing that has spread along the supply chains from China. It has seen a steep decline in global sales, where changes to emissions policies in China and Germany have also had a huge impact. BMW is at ground zero of the macro slowdown, with additional direct adverse effects from the trade wars and Brexit. Germany's manufacturing industry, dominated by engineering and particularly the auto sector, has been in recession territory for 6 months without officially registering a full-blown recession. In fact, Germany registered one of the worst manufacturing figures in the developed world last month when their manufacturing PMI came in at a horrendous 41.9. So BMW has got every possible impediment to delivering results. Now, despite those roadblocks, the German autos have proven themselves to be robust, but BMW's results will really put that to the test. What could happen to the stock? We should look at BMW's biggest competitor, Daimler. Daimler reported on the 24th of October, and after a slight earnings beat on severely lowered estimates, the stock rallied that day up 3.4%. Daimler finished the month as the best performing stock in Germany's headline equity market, the DAX, up 14%, while BMW was only up 6%. No one expects much from BMW on the top line revenues, so this is the time for them to show they've learned how to navigate an increasingly complex global supply chain. What's the bottom line here? Since nobody expects much, the risk seems to be squarely on the upside. A bullish tape in Germany this week, even if the German PMIs are wretched, which is what we all expect, would only bolster this take. Negative headlines with constructive price action would certainly be a strong buy signal for the fourth quarter. The big caveat is if we have a horrendous miss and a lowering of guidance, this could lead to profit taking in the DAX index, which was one of the best performing indices in the world last month, up 3.5%, largely on optimism that the bottom is priced in. Okay, so ISM and BMW are two big events to be aware of this week. But what about what happened last week? I'm referring, of course, to the hugely important after, the non-farm payrolls. A pretty decent beat came in at 128,000 new jobs versus an expectation of 89,000, and a huge upward revision that added an additional 95,000 jobs to the previous readings. So it seems the Fed might just have been right to put a pause on rate cuts, which look like they may already be adding some positive mojo to the economy. The S&P's rallied about 40 basis points off of it, which is not exactly earth-shattering, but we might be close to a near-term top in equities as the Fed cut is being fully digested, along with the realization that the Fed might now be on hold for some time. But watch US banks, who will likely love the fact that the economy is firm and that rate cuts are on hold. It gives their margins a tiny bit of respite. There it is, ISM, BMW, non-farm payrolls. 3 events that have or will shape the markets for the rest of the year. I'm Jamie, and this is Before and After, the twice-weekly market show from Refinitiv. Join us again on Friday, and be sure to share this video.